Eleanor Creagh, senior economist with REA Group. Eleanor, can I just take you through some of these markets right now? It seems as though now lockdown, there's going to be potentially a surge of potential sellers putting their properties on the market between now and Christmas. Does that have an impact on prices, on the overall markets as well?
Yeah, look, I mean, I think it could do. We're certainly seeing that there's this kind of flurry of activity post-lockdown, particularly in Melbourne, you know, where vendors weren't even allowed to show people through their properties for most of September. And we're seeing as we approach Christmas and selling season cools off, we're getting maybe a little bit of a race from sellers to bring their properties to markets. It's certainly reflected in the big auction numbers we're seeing. And, you know, this is a welcome development for buyers, right? Because we know that demand remained very elevated throughout lockdown, but there just wasn't that supply of properties for sale. So certainly, I think, you know, we've got this increase in listings. We know that new listings increased 22% month on month in September nationwide. And we have seen that follow through to October as well. And, you know, it's just a little bit less competition, a little bit more supply. So I think it could take some of that heat out of the market at the margins. But I think there's bigger factors in play.
Because there's two factors here, aren't there? That one is that for the buyer, that more choice means they can be a bit more selective as to what they're going, as distinct from having the fear of missing out. From the seller's point of view, they're wishing to test the markets to see whether they can get maximum dollar in their mind for the property that they've maybe been sitting on, watching this boom unfold before them. So there's the two factors here that are really going to be tested at the margin to see whether those prices actually do continue to move in the way in which they have over the past 12 months.
Yeah, certainly. And I mean, I think we're approaching this point as well, particularly for sellers, where we're at these vaccination thresholds now, where lockdowns or large-scale lockdowns as a strategy for managing COVID are ditched entirely. So there's just a lot less uncertainty on the horizon. And I think that really is translating into this big uptick in seller confidence. And we are seeing, you know, new listings rise in quite a significant way. So certainly there is going to be that interplay of just a little bit more choice for buyers to take advantage of. I mean, I do think that, you know, we're still going to have pretty buoyant activity, but there's other factors in play as well. You know, we're reaching this sort of juncture in the market where, yes, we've had mortgage rates declining to record lows, but they're not going any lower, right? And prices have significantly run higher since that decline in interest rates. So we can kind of say that some of that or that benefit of lower rates is expiring somewhat. And I think that in itself would point to a moderation in price growth from here on out anyway. We've also got the regulator, who we know is keeping a very watchful eye on the market at the moment. APRA have already moved, but I think they've left the door open for more potential measures should we see credit growth continuing to outpace income growth. We've also got lockdowns lifted. People are getting back out spending, you know, borders are reopening, holidays are coming back. So there might be slightly less discretionary spending that's funneled into housing as well.
OK, so the one thing about those interest rates, and obviously we've heard and seen from the Reserve Bank that they don't want to move interest rates for the next 12 months, but then after that, all bets are off. They might get squeezed with inflationary pressures starting to rise. The one thing as to whether, you know, it's not that first interest rate rise or maybe the second, but at some point it's almost like straws in a camel's back. You put too many straws on, eventually the camel falls over. So, you know, the housing market's not dissimilar. All markets are the same way. But certainly early interest rate rises, they've been, you know, sort of, if you like, factored in by banks. They've probably been factored in by buyers of properties as well. It's just a question of how many is too many interest rate rises.
Yeah, certainly. And I mean, I think the Reserve Bank, although their mandate is not house prices, they are very cognizant of house prices. They do know that to date, the household wealth effect from this extraordinary run-up that we've seen in house prices has played a significant role in the recovery from COVID to date. And I think they are mindful of that. I mean, as you say, if they get really squeezed by inflation, it's going to be a different story. And we do know that there is some uncertainty at the moment with inflation, particularly on the global front. We're seeing that, you know, global inflationary pressures are rising, and it's maybe a little bit of an uncertainty as to how those will translate through to our own economy. But I think with the Reserve Bank being very cognizant of all those factors, of course, we do have some uncertainty, but I think that the kind of prospect of rates rising too far and too fast at this stage is relatively unlikely.
Tell you what, Eleanor Creagh, many thanks for your time. Appreciate your time on the program.